today I will be quickly going over sources of capital in real estate. So sources of capital used to fund projects come in the form of debt, equity, and cash flows. In real estate, these can be broken down into more specific categories. So first off, just covering debt. First, we have senior debt. Senior debt refers to a loan that must be repaid first if a project fails. In the capital stack, senior debt is at the bottom, indicating that it is the safest loan due to the priority it has over others in case of foreclosure or default. This form of debt is typically secured by a lien against some type of collateral. And finally, due to the low risk factor, senior loans commonly carry very low interest rates. Next, we have construction debt, as we can see here in the capital stack section and the sources and uses of cash section. So construction debt is a short-term loan used to fund the development of a real estate project. In this model, we have a multifamily development project that we will be covering as an example. So the developer borrows money in the form of a construction loan to cover the costs of a project before receiving any long-term funding. Due to high risk, construction loans have high interest rates as compared to traditional loans. And finally, the last form of debt I want to talk about is mezzanine debt. Mezzanine debt bridges the gap between debt and equity funding and is considered the highest form of risk when it comes to debt. They are subordinate to all forms of debt but are senior to equity. They are often unsecured and are based on a company's ability or a real estate project's ability to pay back with free cash flow. Therefore, they charge higher interest rates compared to senior debt and other subordinate debt. Next, moving on, we have the equity section of the sources, and these fall into two main categories. We have limited partners and general partners. So outside investors in an investment firm are commonly referred to limited partners or LPs. They have limited liability and limited management control on the investments. LPs are usually just interested in the return on equity capital provided to the fund to carry out their plans. General partners, however, share profits and liabilities of the company. Unlike LPs, they have unlimited liability for all debts and generally assume full management control of the entity. The equity capital put in by GPs are small compared to debt funding, as well as equity funding from the limited partners. And we can see that here as the equity amount of the total funding, which is about $27 million, is fairly small compared to the total debt, which is the sum of the construction debt and mezzanine debt. And furthermore, the general partner amount, which is being funded for the equity, is only 15% as compared to the 85% that's being funded by the limited partner. And finally, we have project cash flows. So this is pretty rare, but in real estate, the net operating income from a certain project can be used to offset project costs and reduce equity needs. This is not a primary source of capital, but can provide some if necessary. So for example, if a project is up and running and they have some excess cash flow, they can use that to fund any of the expenses needed to further develop or continue the project. So right here in this example, as I have shown you, we have the construction debt, equity, mezzanine debt, and once again, the equity is broken down into general and the limited partners. So to further walk this through, so if you want to see how we derive the amount that's coming from the limited partners, general partners, and the equity as a whole, we could go to the waterfall model. And right here in the waterfall section, I have the limited partner summary statistics and also the general partner summary statistics. So if you see here on peak capital, we can see that this is the amount that was provided by the limited partners, and this is the amount that was provided by the general partners. And that's reflected here too as a negative sign, and right here as well as a one-time payment from the limited partners and general partners. So if I were to sum that up real quick, So I would get around $5.4 million, which is enough to cover the $5.267 million equity requirement of this project. So how do we derive the $5.26 million worth of equity requirement? To figure that out, we have to go to the construction budget section. Here we see how the total budget was calculated. We see that the subtotal of hard and soft costs were added to land costs, construction interest, and financing fees to figure out the total budget or the total needs of this project. After that, we were able to secure $20.3 million worth of construction debt, as that's also reflected here in the sources and uses of cash section in the model outputs tab, and also $1.5 million worth of mezzanine debt, which is also reflected right here. So in order to calculate the amount of equity capital that's needed, we simply subtract the amount of debt that we secured from the total budget requirements. And if we are able to take information from the waterfall tab, the construction budget tab, and the model outputs tab, we can figure out that we have enough money to secure this project and have it continue successfully. So in conclusion, debt, equity, and sometimes cash flows can be used to fund costs associated to real estate projects. Debt and equity can be broken down into the following categories. Debt has construction, senior, and mezzanine debt. Equity has equity from limited partners and also general partners. Combinations of these two forms of debt are used to finance the majority, if not all, of project costs. But if needed, a company can further fund the project through the use of cash flows that it generates.